Today I'm going to break down a concept that can be really confusing if you're buying a newly constructed house, and it's going to be the difference between improved and unimproved property taxes, how it affects your escrow account, and ultimately your monthly payment. There are two ways to set up your escrow account, and it's super important that you understand this so you know the potential downsides of each option. First, let's talk about what an escrow account is, because I know that can confuse a lot of people. It's like a savings account that holds your property taxes and home insurance until the end of the year when the mortgage servicer makes that payment on your behalf. Think about it like a savings account. Every month when you make your monthly payment, a portion of that payment goes into escrow for your property taxes and home insurance. At the end of the year, the lender pays these items on your behalf with the money that's in that escrow account. Normally, on an existing house, one that's already been completed, we'll collect 3 months of property taxes at closing. Also, the seller is going to owe property taxes on the house from January 1 to whatever day y'all are closing. And they'll pay their portion of the property taxes at closing in the form of a credit. But new construction is completely different, and there's actually two different options, and that's what I'm going to break down in this video. Before we get into the different options, let's talk about how property taxes work. The county is going to assess your property and say what they think it's worth. So let's say they think your house is worth $400,000. That is going to be the taxable value of your property. They'll multiply that by whatever the county tax rate is. So say that the county tax rate is 2%. They'll multiply your value of $400,000 by that 2% tax rate to give the taxable amount due. Usually the county reassesses property values around November. So the county might be valuing that property just off the raw land because there wasn't a house on that property when they last reassessed it. This is what we call unimproved value, where they have not reassessed the property and they're only taxing it based on the land value. Improved taxes are based on the land value plus the completed property. Okay, what are the options? If you're buying a new property that has not been reassessed, then you have two different options. How you choose to set up your escrow account is going to impact your monthly payment and your cash to close. This is the part that's frustrating for people and it's hard to understand. Option number one, you could choose to set everything up with unimproved taxes. If you set everything up on unimproved taxes, you're going to pay less initially, but you're going to need to readjust whenever the county reassesses the property value. So let's pretend that you're buying a house in August. The month doesn't really matter, but let's just pretend it's August for this example. Let's pretend that the unimproved taxable value for this property is $900 for the year, or about $75 a month. And you're buying a $400,000 house and the county tax rate is, say, 2%. So this means eventually your property taxes are going to jump from $900 a year to $8,100 a year, or about $667 a month. So since the builder owned the property from January 1st all the way to when you're closing in August, they're going to owe property taxes for the months that they own the property. So they're going to give you a credit at closing for their portion of the property taxes for about $525. Your lender is going to collect property taxes based on the unimproved value of your house, so it's $75 a month. Plus, once your payments kick in, you're going to make 3 payments before the end of the year that are also going into your escrow account. So what does this mean? So number one, your monthly payment is going to be artificially low until they reassess the property come next year. But since the lender is collecting off the unimproved tax value, you're going to need less money at closing. And this is where you're going to run into an issue. When the county does their reassessments in November, they're going to see the house is now complete and you own it. They're going to assess the property at whatever value they come up with. Usually it's pretty close to what you bought it for. Then they're going to issue a tax bill based on that new value due at the end of the year. Using our same example, let's say this new bill is $8,000. Well, your mortgage company has collected a little bit over $900, so we're going to have a big escrow shortage. We're going to be short over $7,000. So come January 1, when your mortgage company goes to make that payment to the county, they're going to still pay it, but they're going to give you two options to reimburse them. Option number one is you can write a check for the full amount that you're short by. Option number two is your mortgage company will allow you to pay this out evenly over the next year, but this is going to increase your monthly payment by over $591 a month. So if we take your shortage of about $7,000 divided by 12, that's going to give us about $591 extra that you're going to be paying on your mortgage payment. But we're not done. There's one more big change. Since your new tax bill is $8,000, since your property has been reassessed, the mortgage company is going to need to collect more money from you each month to make sure they can cover the bill that comes out next year. So the $75 a month that you've been paying in is going to jump to the $667 a month that it should have been at. And for your escrow shortage, if you went with option number two, where you pay it out evenly over the next year, your payment's going to increase by that amount, plus the new property taxes of $667. So it's going to make your payment go up by over $1,200. If you went with the first option of paying the amount in full, your payment's only going to go up to the $667 based on the new property tax value. So knowing this information, if you can set aside enough money come into year to where you can pay that amount in full, then you're not gonna have a $1,200 increase on your payment. Okay, let's talk about the second way to set up your property taxes and the way that I generally recommend people do it. Instead of setting up your property taxes based on the unimproved tax value, we're gonna set them up on the improved tax value, or our estimation for what the improved value is gonna be. So we're gonna assume that the new taxable value is $400,000 like we have been during this example. Since we're setting them up on improved, we need to make sure we have enough money in the escrow account come into year to make that $8,000 payment. The only problem is we're in August, your first payment's not due until October, so you're only gonna pay in 3 months into your escrow account. So we need to collect the remainder at closing. So to figure out how much we need to collect, we'll usually take whatever month we're closing in plus 3. So if we're closing in August, we have 8 plus 3 equals 11. So 11 months of property taxes collected upfront. In this example, the builder is still going to owe the property taxes for the first half of the year, but they're only going to give you a credit for the unimproved tax value. So it's only like $500. So obviously the drawback is you're gonna need more money at closing. I like this option for 2 reasons. Number 1, your monthly payment's not gonna change at the end of the year. There's gonna be enough money in your escrow account to make the property tax payment, so that way your monthly payment is not gonna change. And the second reason is because you're not gonna get a massive tax notice at the end of the year saying you owe a bunch of money for property taxes. So when you hear about people getting a huge shock a year after buying a new property, now you know why. They set up their property taxes on the unimproved value, and their lender didn't prepare them for what to expect and how to avoid that. So you can set up your property taxes however you want. I just want you to know the drawbacks of each option. I think option number 2 is the best because most people aren't going to be disciplined enough to set aside enough money to make sure that payment is made come into year. So I know this topic is super confusing. There's a lot of information. It can be really confusing. So if you need any more information or you want to talk about this in more detail, please feel free to reach out to myself or my team.